When I teach accounting, I like to point out the differences between black and white accounting, gray accounting, and go to jail accounting. Many of accounting's rules are pretty black and white, and sometimes people push the interpretation of a rule to make it sort of gray and unclear if it's acceptable treatment or not. You probably want to be careful with applying accounting rules too aggressively, as it could result in restatement or violation of your debt contracts or worse. Then we have go to jail accounting. That is fraudulent in nature, and it is meant to deceive investors or stakeholders. The fastest way to go to jail in accounting is to misrecognize revenue. History is full of stories of managers needing to make aggressive end-of-the-year sales targets or profit targets and reaching out to their customers trying to generate just a few more sales. The sales rep says, "Hey, I'll give you a great deal if you buy another truckload of product before the end of the month." The customer might say something like, "Sure, that sounds great. Go ahead and place the order." When the sales rep records the revenue, that company may be committing fraud, and that sales rep, or more likely the company's financial controller, or potentially even their CFO, could end up in jail, depending upon the impact of those transactions. What could possibly be wrong with this behavior? Stick around to find out. When should businesses recognize revenue in their income statement? When a customer calls and places an order? What if the customer says, "I want to place an order that I want delivered next month"? Should we book the revenue when we ship the product to the customer? Maybe we should recognize the revenue or the sale when we get paid by the customer. Well, actually, all of those might be wrong, but they might be right too. It really depends upon the circumstances. Since revenue is arguably the most important number of any of the financial statements, and it is the largest number on the income statement, it has the biggest impact on profit, and it can give us a very good idea of how a firm is doing. Are the company's products being accepted by customers? Are sales growing over time? How big is this company compared to their competitors? Revenue recognition refers to the recording of revenue that reflects the benefit a company receives or will expect to receive in exchange for goods or services provided to the customer. Usually, we're talking about cash, or maybe a promise to pay cash in the near-term future. But sometimes the company might receive product or another asset in return. In most cases, the timing of the receipt of cash does not indicate when a firm should recognize the revenue. We have a 5-step process to regulate revenue recognition. Step 1 is to identify the existence of a contract with a customer. For many businesses, there is an actual contract that will be signed by both of the parties. But more commonly, we have implied contracts, such as the price on a piece of fruit at the grocery store. We all understand that if we pay the 50 cents for a banana, we take ownership of the banana. However, contracts can also be verbal, which can lead to misunderstandings, so be careful with those. Step 2 is to identify the performance obligations in the contract. Often this is the delivery of a product or the performance of a service, but it could be more complicated in the form of, say, a subscription or an insurance policy. Step 3 is to determine the transaction price. The transaction price is normally clearly stated. Step 4 is to allocate the transaction price to the performance obligations, which can be tricky. This often involves one price and one performance obligation, such as 50 cents for the banana, so that's easy. But in the case of subscriptions or other multi-obligation arrangements, it can get messy. In step 5, we recognize revenue when the performance obligation is satisfied. I learned revenue recognition under a simpler system years ago. But in the end, the old system and the new system are not that different. The idea is that we need to agree on a price, deliver our side of the agreement, and be reasonably assured that the other party can pay us. As long as you have those 3 items, most of the time anyways, your revenue recognition process is pretty easy. Some common errors with revenue recognition include booking revenue when an order is placed. We can't book the revenue before the customer receives the product, so that would be wrong. 2, booking revenue when a shipment is sent. It really depends upon when the title transfers to the buyer. If the shipping terms are FOB, which stands for free on board, destination, then that means that the customer is free from any responsibility while the goods are quote-unquote on board or in transit. In that case, we haven't delivered the goods until they actually arrive at the customer's receiving point. But if the shipping terms are FOB shipper, then we, the shipper, are free from responsibility while the goods are in transit, meaning that title transfers when the goods are shipped and revenues should be recognized accordingly. Delaying revenue recognition until the customer pays is error number 3. We only have to be reasonably assured that the customer will pay in order to record the revenue, so we don't have to wait for the actual payment. Hopefully this has helped to demystify revenue recognition for you just a little bit.